Every day, the money in your wallet is quietly shaped by decisions made in government offices you may never see. From tax changes to interest rate adjustments, and from spending on infrastructure to regulating industries, government economic policies influence how much you earn, spend, and save. These policies can make your groceries cost more, your loans more expensive, or your investments grow faster. Understanding how these decisions ripple through the economy helps you protect your finances, plan smarter, and even spot opportunities to make your money work harder. Let's explore how government choices directly impact your financial life. Today, we will talk about how government economic policies affect your money. So, before we start, make sure to hit the like button and subscribe to my channel. Governments have a profound influence on the daily financial lives of individuals, often in ways that are subtle yet far-reaching. Economic policies, ranging from taxation and spending to regulations and monetary interventions, serve as tools for managing a nation's economy. While these policies are designed with national objectives such as growth, stability, and social welfare in mind, they inevitably touch the money in your pocket. Every decision a government makes, whether it's adjusting tax rates, controlling interest rates, or regulating industries, can affect what you earn, what you spend, and how your savings grow over time. Understanding these mechanisms can help you make informed financial decisions, anticipate economic shifts, and protect your financial well-being. 1. Fiscal policies, taxes, spending, and your wallet. Fiscal policy is the government's approach to taxing and spending, and it directly affects disposable income. When the government increases income taxes, workers see less take-home pay, which can reduce consumer spending and savings. Conversely, tax cuts provide households with more money, often stimulating demand for goods and services. Government spending, particularly on infrastructure, healthcare, and education, injects money into the economy, creating jobs and increasing household income indirectly. For example, when a government invests in road construction, construction workers earn wages that they then spend on goods and services, boosting local economies. Conversely, austerity measures, where governments reduce spending to control debt, can slow economic growth and affect employment levels, thereby reducing household income and financial security. 2. Monetary policies. Interest rates and inflation control central banks implement monetary policy to regulate money supply and stabilize the economy. One of the most visible ways this affects individuals is through interest rates. When a central bank lowers interest rates, borrowing becomes cheaper, encouraging spending and investment. This is good news for people taking mortgages, car loans, or business loans. However, lower interest rates may reduce returns on savings accounts or fixed income investments. Conversely, raising interest rates increases borrowing costs, slows down spending, and can dampen inflation but may benefit savers with higher returns. Moreover, monetary policies influence inflation, which directly impacts purchasing power. Even slight increases in inflation can erode the real value of wages, meaning that your money buys less over time. 3. Employment and wage policies. Minimum wage and job security. Government economic policies also shape the labor market, affecting how much you earn and how secure your job is. Policies such as minimum wage laws, labor protections, and unemployment benefits determine baseline income levels and safety nets for workers. By setting minimum wage thresholds, governments ensure a floor for earnings, helping households cover essential expenses. Labor protections, including limits on working hours and benefits like paid leave, also influence disposable income and work-life balance. Additionally, policies promoting job creation in specific industries can create new employment opportunities, which increases household income and stabilizes communities economically. Conversely, deregulation or cuts in labor protections may reduce job security and downwardly pressure wages. 4. Trade policies, prices and availability of goods. Trade policies, including tariffs, import restrictions, and free trade agreements, impact the prices and availability of goods and services. For instance, tariffs on imported products often increase the retail price for consumers, meaning your everyday purchases from electronics to groceries could cost more. On the other hand, free trade agreements can lower costs by increasing competition and allowing access to cheaper imports. Trade policies also affect domestic employment. Protecting certain industries may preserve jobs, while exposure to international competition can lead to layoffs in less competitive sectors. In this way, your household budget is closely tied to the government's decisions on international trade, whether you're aware of it or not. 5. Regulatory policies, banking, finance, and investments. Governments regulate financial markets to protect consumers and maintain economic stability. Policies governing banks, insurance, and investment firms determine the safety of your savings, loans, and investments. For instance, deposit insurance ensures that even if a bank fails, your money is protected up to a certain limit. Regulations on lending practices can influence the interest rates and terms of your credit, affecting the cost of mortgages, credit cards, and personal loans. On the investment side, government oversight of securities markets ensures transparency and fairness, helping to reduce the risk of fraud. Conversely, excessive regulation can limit investment opportunities and slow economic growth, indirectly affecting potential returns on your assets. 6. Social policies, welfare, subsidies, and household support. Beyond taxes and spending, governments implement social policies that directly affect household finances. Subsidies for essentials like fuel, food, or healthcare lower living costs for consumers. Social welfare programs, including unemployment benefits, pension schemes, and child allowances, provide a financial safety net that can stabilize income during hard times. These policies not only help vulnerable populations, but also influence consumption patterns, as households with reliable support are more likely to spend on non-essential goods, stimulating broader economic activity. Reductions in subsidies or welfare cuts, however, can increase household expenses and reduce disposable income, affecting the overall standard of living. 7. Inflation and currency policies. Maintaining purchasing power. Governments and central banks influence inflation and currency value, which directly affect the real value of money. Policies that lead to high inflation reduce the purchasing power of cash, meaning that everyday items like groceries, fuel, and rent become more expensive over time. On the other hand, stable inflation policies preserve purchasing power and maintain financial predictability. Currency policies, including interventions in foreign exchange markets, can affect import and export prices, impacting both costs of goods and investment returns. For individuals, understanding these policies is crucial, as inflation can erode savings if interest rates on deposits fail to keep up with rising prices. 8. Long-term impacts, financial planning, and wealth accumulation. The cumulative effect of government economic policies shapes long-term financial security. Policies affecting taxation, interest rates, social support, and inflation determine how much you can save, invest, and accumulate wealth over time. Strategic planning, such as investing in tax-advantaged accounts, diversifying assets, and monitoring inflation trends, can help households navigate policy changes. Additionally, staying informed about policy shifts enables individuals to anticipate impacts on housing costs, loan rates, and investment performance. Ultimately, government economic policies are not abstract decisions. They are forces that shape everyday financial realities, from what you earn to what you can afford, and from short-term budgeting to long-term wealth accumulation. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.